Welcome to our presentation on synthetic equity. Today we're looking at it as a powerful approach to compensation. About 20 years ago, when FP Transitions was beginning to design and implement succession plans, we came across an interesting challenge and opportunity. We learned that with almost every plan, we needed to bring in our team and do a reset on compensation. The issue of ownership level compensation means that G1, Generation 1, plus G2 and G3, who is the founder and the successor team, they were always the highest paid group of people in the company. And that meant that ownership level compensation has a big impact on the level of profitability of the firm. We can help you align the power of equity and the flexibility of compensation to build a business that lasts and is capable of rewarding and retaining key talent. For our agenda, first of all, we're going to talk with you about why synthetic equity can be so useful. This is a tool that independent advisors need to be aware of and need to consider in terms of how you're going to be able to hang on to your talent. Next, we'll talk about examples and common applications of synthetic equity. Who does it work for? And in what circumstances does it make sense to implement this strategy? We'll show you how it differs from true equity also. We'll review the key benefits and talk about the essential planning elements for your own strategy and help you to start getting your thoughts aligned in this area. I'm Kem Taylor. I'm a senior consultant here at FP, and with me today is Stuart Smith. He's an attorney and one of our lead senior consultants on the synthetic equity program. Stuart, can you tell us why synthetic equity is so important these days?
Thank you, Kim, and thank you to everybody who's listening today. I'm going to give a little background to start. When FP Transitions was founded almost 25 years ago, the first thing we had to figure out was how to value companies in the independent financial advisory space, because nobody had really done it before. And in doing that, we discovered just how critically important compensation is to value. And then over the next 10 years or so, we helped several hundred companies to implement succession plans of bringing G2 advisors into ownership. And in doing that, we've discovered that there's still a lot left on the table that we hadn't understood, particularly as to the individuals who are not yet ready to be owners. That there's a big gap between compensation on one side and equity on the far other end of the spectrum. So what is synthetic equity? 10 years or so ago, the only people that used what we call synthetic equity were large corporations that had either a large in-house staff of attorneys or the ability to spend hundreds of thousands of dollars with employment counsel to develop plans for either their senior executives or for a broad swath of employees across the organization. In the space where businesses, really small businesses of say between 3 and 100 people, nobody was using synthetic equity. And when we started to study this, the first thing I realized was there was no textbook to tell us how to do it. I spent literally hundreds of hours reading case law, reading statutes, regulations, plans written by large companies to try and figure out how we could apply this to our clients in a way that made sense, that was cost effective for them, and importantly, compliant with the tax code, because it's really complicated. So what does synthetic equity do? Synthetic equity gives you the ability to compete with other advisory firms for new talent, because most firms don't offer this. It gives you the ability to incentivize employees to look towards the future, to align what they are doing with what you as the owner of the company wants to be done. It preserves your cash flow, as typically nothing is paid out today and nothing is paid out until certain goals are met and certain timeframes have passed and the company has grown or other metrics have been achieved. And it encourages employees to think like owners without them having to actually be owners. So it gives you some tools for all the people in your organization who are either not ready to be owners, who are not licensed, who will never be in a position to be owners. Even the people that work at the front desk in some cases are eligible to be owners of synthetic equity, who would not otherwise be eligible to be owners of the company. So I want to give you some examples of different uses for synthetic equity. We have a lot of clients come to us who truly want to share the value of what they've built and what they're building with their staff, but don't want to go through the complexities of actually transferring equity to somebody else and having somebody else with them making decisions. Synthetic equity is a great tool to fill in that gap. It's a great tool for individuals who are either unable to write a big check to you to become an owner, or they're unwilling to, or they're simply not ready to take on the risk of doing that and still get ownership-like returns. We get a lot of clients coming to us who really don't have the runway left to put in place a succession plan with the employees that they have to get enough equity into their hands so they can become owners of the business when the owner wants to retire in, say, 3 to 5 years. But they want those folks to be able to have a true economic stake in the business, so we can set up a plan where they share in the value of the business when it is sold, and they're incented to stick around and stay with that company for the next few years until it is sold, and then through that transition, and then more than likely stay along and be an employee of whoever acquires them. A lot of people see this as, what's referred to as golden handcuffs. It's money out into the future that's available for that employee if they stick around and complete certain tasks over a period of time, knowing that if they don't, they aren't going to achieve it. It's available, as I mentioned before, for truly anybody. In a business where you have revenue that's derived from a broker-dealer, from commissionable transactions, most broker-dealers really don't want you to have owners who are not licensed. Synthetic equity, it's not ownership, so it can be deployed to virtually anybody in your organization. It's also oftentimes used for young people that come in that are eager to be owners. You see them as likely to become owners, but they're 23, 24 years old. They've got some maturing to do, some growth that needs to happen, some licensing that needs to be obtained. So synthetic equity is a great way to reward them over the next 5, 6, 7 years until they're ready to become owners. And then there's businesses that are still, they manage independent books and they don't have a real center of value yet, but they're growing and they're profitable, and they want to take steps to retain those advisors in a very competitive business, and synthetic equity is a great way to do that. Well, did you have any thoughts on this one?
Well, I was just going to say, I am in fact working with a client right now, and they came to us and wanted to offer equity to three younger advisors. They were all on the call, they all got along. And as we started having these discussions, they realized the founder wants to be out in about 5 years. And in looking at how much it would cost for those next gen advisors to buy him out when he wanted to leave, it was just not going to be affordable at all. And they also felt like bringing in new owners and then just having the owner leave didn't really give them enough time, to really develop and become leaders. So they did one of the plans that you talked about. Not only are the advisors going to get a share when the founder sells the business, but he's also going to offer that to the other staff members as well. So in 5 years, when the business is sold, they're all going to get a percentage, which is going to incentivize them to actually grow the value of the business too. And he's lucky in that he's identified a local firm who is going to step in and do that purchase. So having that ability to do a synthetic equity plan really was a great plan B for this group. So here, this is what Stuart was talking about, looking at kind of the spectrum of incentives. So we have compensation on the one hand, and that's what most people use. Equity is on the other end, and bigger firms offering equity to the next generation of advisors and really building legacy firms. So right in the middle is synthetic equity. And really before we start thinking about that, we want to make sure that we're pretty strong on either end. So with compensation, our consultants can work with our clients to talk about how to pay people, how much they should pay them, and then the legal folks can talk about corporate structure on the equity side. And everything else in the middle, synthetic equity, can run the gamut. There are probably hundreds of different types of plans that we can help set up. And this is where we really start to get flexible. As our job as a consultant and a guide for you, we really want to understand what you need, what you're struggling with, and what you need to accomplish before you call it a day. We also want to give you enough information so that when you sit in front of, say, that 34-year-old CFP who's not yet an owner, and you want to offer synthetic equity, you are able to talk with them about how the plan is going to work. When you look at comp, that's really kind of a short-term solution. And equity is a very long-term solution, usually career length. So that's why we have in the middle the option of synthetic equity. So I'm sure many of the people who are listening today are founders or already equity partners in an S Corp or an LLC partnership. And when you set up an entity like that, you have what we call true equity. So before we dive into synthetic equity even more, Stuart, can you talk a little bit more about the rights and responsibilities of true equity?
Sure, thanks, Kem. So equity is made up of what are effectively a bundle of rights. And on the right of this slide is a list of 7 attributes of equity. Governance simply means as an owner, you typically are the decision maker. You may delegate smaller day-to-day decisions to others, but you're going to reserve for yourself the right to sell the company, to do an acquisition, to sign a lease, to spend large amounts of money and many other things. And in making those governance decisions, you have voting rights. When you operate through an entity, you as a shareholder have limited liability. One of the key motivators of being in business is profits. As the owner of equity, you have the right to take profits out of the company. If you operate as an S Corp, everybody shares equally based on their ownership interest. Partnerships, usually it's the same, but it can be different. Equity owners enjoy capital appreciation so long as the company is doing well. And when they realize that appreciation, they pay taxes at long-term capital gains rates. And as owners typically have access to all the records of the company, although for a minority owner, it can be limited. When we talk about synthetic equity, let's stay on that previous slide for a moment, Kem. The only thing that really is guaranteed is you still get limited liability because you're working for that entity, but you don't get a vote. You don't get a seat at the board of directors or the board of managers table. You don't necessarily get profits, but the synthetic equity plan could give you a share of profits either now or in the future. Oftentimes, synthetic equity is tied to capital appreciation, and we'll talk about that in more detail. Unfortunately, long-term capital gains usually don't apply to synthetic equity. Synthetic equity holders, with one exception, pay tax at ordinary income tax rates. And when that check is written to the employee, the employer gets a deduction for that same dollar amount. And since it's just an incentive plan, they don't get any access to the financial records. So you can really, with a synthetic equity plan, divide up these rights wherever it makes sense to do it. So what are the benefits of synthetic equity? It's hugely flexible. Oftentimes there's going to be a vesting schedule. Vesting means that someone has achieved the right for a particular payout after either a period of time that you've set in advance has passed, or you can set other objectives. So somebody passing the CFP exam, for example, you can set an objective that the company has to grow by 15% each year for the next 3 years before this plan vests. It could be individualized for a particular employee that they have to bring in a certain number of new clients or a certain number of assets, or grow the book of business that they are managing for you, or that they just get a haircut every month for the next 2 years. Vesting is incredibly flexible and is designed to meet what you need it to be. At the other end of the spectrum is the payout. It is flexible in many cases, but based on some decisions, there are some constraints on payment terms and timing that we'll go through with you as we create the plan, but you still have a lot of flexibility. With vesting, the metrics that you can use are almost unlimited. And those metrics can not only be tied to the vesting schedule, but they can also be tied to the payout schedule. The majority of plans are directly tied to the value of the company and the growth of the value of the company into the future, but they don't have to be. Sometimes plans are strictly based upon a specific financial metric, either for the individual employee or employees, or for the company as a whole, that's applicable for those employees, and that those employees have some ability to influence. Within a partnership, that's where you have some more flexibility, and there's what's called a partnership interest, which we'll talk a little bit more about, that does eventually pay out at long-term capital gains rates. And through this flexibility, you have the ability to align the interests of the owners and the employees and truly do what's necessary to focus everybody's attention on growing the business, which will ultimately drive in growing the shareholder value. And, for better or worse, if the plan doesn't work out and no check is written because a certain goal wasn't met, the company hasn't spent anything beyond setting up the plan. So when we sit down with a client who wants to put a plan like this into place, we'll start out by asking lots of questions. Are there certain behaviors that you're trying to incentivize with your employees that they're not doing today, that a potential financial incentive in the future might change their behavior? Determine who's going to participate. Is it a select group of senior executives in the company? Is it all the advisors in the company? Is it everybody? Is it one individual who is on the track to be, a future owner but isn't ready? Need to figure out, when is it that you want to ultimately write these checks? Is it 3 years from now? Is it 10 years from now? Is it only if the company is sold in some time in the future? And then critically, how much money are you willing to share at the end of the day? And that question is a balance between, how much of a check you're willing to write with how much is it going to take to incent the individuals that you're trying to get their behavior to help you grow the company. And that's a question that's really hard to define, but it's one that needs to be solved and that our analysts can help you to put into black and white. So there's a spectrum of types of plans, some that live within very narrow constraints of the tax code, and some that have, well, to say a whole lot more flexibility. On the left are what we call appreciation plans. These are usually tied to the value of the company. So, for example, a stock appreciation rights plan will value the company, and if it's currently valued at, for say, $10 a share, the rights will be issued at $10 a share. And if they mature when the company is worth $20 a share, the employee is entitled to the difference. 20 minus 10 is $10, again, paid at ordinary income tax rates. Those plans usually don't last more than 10 years, usually at least 3 years. You need to have what's called a 409A compliant valuation done, but they're pretty straightforward to manage and understand. And, from an economic standpoint, it's really the same as issuing a stock option for the company. The difference being, with an option, the employee has to come up with the money to buy the stock and realize that difference. With a stock appreciation rights plan, it's the company's obligation to write that check. Sometimes these can be written such that instead of writing a check, you're issuing company stock to an employee. Rarely does a plan actually say it's going to be paid in stock rather than cash. It is a decision you have to make up front. The reason being that, in 7 or 10 years, it's really hard to predict if you want this individual to be a shareholder in your company. And whether or not you pay them in cash or in stock, it's going to be taxable. So the better route is normally to pay them in cash. And if you want them to have the opportunity to buy stock at that time, give them the opportunity to use the after-tax proceeds to turn around and write a check back either to one of the existing owners or the company to become a shareholder. With a partnership, you have another alternative, which is a profits interest plan. The profits interest plan is economically the same as the stock appreciation rights plan in that it participates in the upside in the value of the company. But unlike a stock appreciation rights plan, it is actual equity. The recipient becomes a partner in the company. They sign on to the partnership agreement. Normally, they're going to have access to profits. They may get a seat on the board. They're going to have voting rights. Sometimes they won't have voting rights. They'll have access to the books and records. And eventually, long-term capital gains rates. When either of these appreciation-only type plans are granted to an employee, that is not a taxable event. The IRS says that because it's granted at the current value of the company, it has no value. So no tax bill is due. The company doesn't get any tax deduction either. In the middle of this slide are what we call full value plans. A phantom stock plan is very similar to a stock appreciation rights plan, except that when the grant is made, instead of getting a appreciation right, you're getting a full value share. So in that same example that we gave earlier, where the company is worth $10 a share, they're getting a grant of that share. So if when the plan matures in 5 years and the company hasn't grown at all and still worth $10, they're going to get a check for that underlying value of $10 per share. Now, when a phantom stock plan vests, there is employment tax due on that vested amount. There's not income tax due, but there is employment tax due on it, which is a difference. Another type of full value plan that we've been writing a lot of lately are what we call change in control plans. And these are for companies that are looking to the future with a group of employees that have typically been there a long time. They want to reward, and they really want them to stick with a company until it's sold. They may have a plan to sell the company in a couple of years. There may not be a plan, and it's just in case. But these plans are set typically to award a percentage of the value of the company to specific employees at the time of the sale of the company. They can also be designed such that an employee gets a specific reward for certain activities that they've engaged in over the course of time, such as bringing in new clients while they're still an employee and not a partner in the company, and getting a reward for that when the company finally sells. On the right side of this are what we call performance unit plans. These plans have a tremendous amount of flexibility. Oftentimes, they're fairly short-term in focus, such as creating a target to be met this year, but with a payment that's not going to be made until typically about 3 years out into the future. And then you do the same thing again, and the year after, and the year after that. So it sets up a short-term target and then a long-term objective and a reason for that employee to stick around and do it again before they receive that reward. And these can have objective targets or subjective targets, and the amount that can be paid can be very flexible as well. And they can be long-term with that kind of flexibility. And typically, these plans don't vest until payment is due. So if the employee leaves at any time before that payment, They don't get anything, and there's no cost to the company. And by not having to invest until payment is due, you have a lot more flexibility in the plan design than you do in any of these other types of plans.
So thinking about setting your goals, we do not write 50-page plans. In most cases, they're 5 to 15 pages, and that's more than enough to get the job done. Less is better. These need to be relatively simple to execute, and because as the founder, you're typically the administrator, it's going to be up to you to explain this opportunity to the next gen and also to correctly manage the plan. We also want to make sure that you are achieving your financial business goals too. So this is why we have an analytics team who can help you look at the future and do the math. If we hit the goals, what's the payout? And does that payout support the reward that you get as a founder for putting the system into place in the first place? So that's not easy to figure out, and we want to make sure you get the answer right. Compensation is a powerful tool, but it's also one of the impediments that keeps a small business from being profitable enough to retain the next generation of talent and to provide significant and sufficient return on investment for those who buy true equity. Compensation is one of the things we help our clients with, and our analysts are on nearly every single project with those clients. Synthetic equity here is really a master's level course. We've tried to keep this presentation simple, and we hope that the plans we write will appear simple to you. But as you've heard from Stuart, there is a ton of work that goes into every plan we write to make sure it both meets your needs and also doesn't run afoul of any of the regulations and laws that impact companies. So Stuart, as we're wrapping up, can you talk about how we help structure these plans?
Kem, thanks. So you're going to hear us repeat over and over again that when it comes to compensation, the how is much more important than the how much. We have tons of data to help you to determine how much, because obviously it's important to pay people properly, but our focus is on the how and the incentives that the how creates in getting alignment between employees and owners for the future. If you think about how you pay advisors, if you're paying them a percentage of the revenue derived from the clients that they serve, and over time, their book is growing, which is great. Their compensation can become greater than that of the owners, and that compensation growth very much limits your ability to grow profits of the company. And knowing that profitability is what drives value puts you in a place where you're creating opportunity and income for your advisors, but really not yourself, and you're not creating a business that is investable and that advisors have an incentive to buy into. If the owners are making less than the advisors, they don't want your job. So it starts with what we call a bottom line up perspective. We look at a business from its level of profitability and what those drivers of profitability are. We know that compensation is, without exception, the biggest expense for our clients. So managing compensation is the first and foremost goal of making sure that a company can grow and the profitability can grow over time. So it's about balancing that compensation between the owners and the producers and the advisors over time. Ultimately, you want the variable portion of compensation for advisors to be a share of profits. Now, not every advisor is going to get there. If you just give away a share of profits to the advisors without them having to become owners or having some other synthetic equity product that ties them in, you're actually creating a disincentive for them to ever want to write you a check and become an owner of the business. And after all, why would they do that if they can get that for free? So we need to do that in the right way. And true equity is reserved for, the select few individuals that have the motivation, the drive, the experience, and the knowledge and the ability to drive the company forward and be a really good member of your ownership team and be able to run this business in the future.
So how do you get started? First of all, we recommend learning more. You can read white papers and articles in the resource library on our website. Next, talk to us. This is really not the territory of local attorneys. This is work that we're really set up to provide. We have consultants and analysts, compensation and valuation specialists. We have a team of attorneys to walk you through this process. The way we start is with a strategic assessment. We're going to spend from 1 to 5 or 6 hours with you asking a lot of questions because we know we can't give you good advice if we don't understand what the world looks like from your perspective. From there, we'll look into the future and help design a plan with our synthetic equity team, the designers and developers. We'll help you do the math. When we're all finished, we bring in the lawyers and they're going to document and implement the plan. That's a lot of work to do. It usually takes about 60 to 90 days in most cases to get it all done. But we have all the skills and a team of 70 people ready and willing to make this happen for you. So I want to thank you profoundly for spending your hard-earned time with us to learn more about synthetic equity. And Stuart and I are always happy to have a assessment call to talk about your needs.